What's happening, you guys? Welcome to Risky Ryan Trades. Today's going to be kind of a short video. I just have a short message for you and how I plan to make the most out of this month and really between now and the election. I'm sorry I haven't uploaded much lately. Reason being is that the charts are kind of broken right now. The technicals don't seem to matter a whole lot. And the reason for that is there's tons of uncertainty in the market right now. So what it appears to be happening is Wall Street, the institutions are taking this opportunity to reduce risk. Take a look at the data, because there was good jobs data, then bad jobs data, then good jobs data, then revised bad jobs data. Basically there's a gigantic question mark. Are we going into a recession? What's going on? Nobody knows where to put the money right now. So they're opting to just pull the money out. And I'm going to show you what I'm seeing and why I say that. If you go to the ETFs today, basically nowhere was safe. Technology was down, healthcare was down, utilities were down, consumer staples were down. They're pulling money out of the market. Now, oddly, consumer discretionary, which if you thought that the economy and the consumer was strong, this is where you'd put your money. So kind of strange, honestly, kind of strange to see this here. So there doesn't seem to be a whole lot of clarity. Also, you can see here that treasuries went up today pretty strongly. So this is a defensive move, pulling money out of the market, a defensive move. If we go to a 1 week performance, you can see like tech is destroyed and utilities and staples are still kind of holding up. Healthcare and even financials not doing so well. Oil and energy getting hit, Bitcoin getting hit. So it's very risk off right now. And how I am approaching this month is so this is what I think is going to happen. Everybody knows that September is a bad month. Everybody knows that September on average is a negative month for the stock market. And the stock market is a future-looking device. So what I expect to happen is these first 2 weeks, especially, you're going to see some big red days. You're going to see people know, okay, the markets are probably going to go down in September, so let me just get out. My suggestion, if you have some big winners that look like they're turning over, you could consider trimming those positions. And by the way, disclaimer, this is my opinion only. This is not financial advice. Trade at your own risk. So you got to make decisions for yourselves, but I'm just telling you what I'm doing. And yeah, I mean, if you have positions where you were a little overweight and now you're like, I don't know if I'm going to have a really strong September with this name, start building some cash. And what you can do, what I'm going to be doing is like the NASDAQ, SCHG, even tech, like semiconductors and technology. These are going to get hit kind of hard, I think, along with the Russell. I think the Russell, if the data is not to their liking and maybe there is a recession on the horizon, I don't think the Russell is going to do as good as people think going into those rate cuts. I could be wrong, but what my plan is whenever I see like what we had on Monday where it was like down 3%, I think we're going to get maybe a couple more of those this month. That's when I'll be buying. If I see a significant drop, if I see NVDA below $100, I'm going to start picking up a share or two. I'm going to DCA into this weakness into tech, because and the reason for that is tech in the long run, regardless of the economy, it could be a recession, it could be whatever, it's not seasonal like industrials are, or like financials are, or like materials are, or oil. Like tech just kind of does tech. And It is a more volatile instrument, which means it's prone to having weeks where it's down like 5%, or the SOX is down 6%, SMH down 7%. So I'm looking to, you know, for actually like a day like today where this is a weekly. So today the Qs were basically flat. So I'm not buying today, simply put. So I want to see, you know, a couple percent moves down, then I pick up a share here or there. And I'm going to be regularly buying throughout the month the stocks that I think are going to, you know, and the sectors that I think are going to be doing well over the next 5 years. So think of it like this. All your favorite stocks, all the popular tech stocks, they're going on sale this month and next month and into the election. And, you know, if the stock market is going to crash or whatever, we hit a recession, it kind of doesn't matter what you're invested in. It's going to get hit hard. And really when the stock market dips, when it goes down and tech gets hit hard, that's the time to buy tech. And when the stock market, you know, like when NVIDIA was like just ripping like this and we're right here, that's the time to be buying dividend stocks and value stocks. Then when you get one of these big dips, okay, you start picking up some of the more risky stuff, and so on and so forth. And that way you can kind of create a diversified, balanced portfolio that, you know, you're buying the right stuff at the right time. Like on weakness like this, you know, this is a decent spot to pick up a share or two. And, you know, if it starts to recover and it makes a new high, maybe you buy a little bit more. It'll probably soften, you know, something like that. Or if we make a new low, we come down here, you know, you start to load the boat with NVIDIA at that point. So that's how I'm doing it. If you're a short-term trader, my bias over the next month, especially the first 2 weeks, is to the downside. So like a day like today, where, you know, for instance, the Russell got hit the hardest, I guess, along with the Dow, but, you know, we pump up and then we soften and then it pulls up and then you see some weakness. The trend is your friend. It's probably going to go down more. So, you know, you can take a short position. So, you know, if the overall day we hit 10 o'clock or something, like the Dow right here, we hit 10 o'clock, 10:30, and it looks like, you know, it's not going to be an up day, my bias would be to the short side over the next couple weeks, because like I said, a lot of the institutions are basically going to take profits. They're going to reduce risk, reduce equity exposure, and they are going to be waiting to see some of this data to see where they should be putting their money going forward, going into the year end and going into 2025. So I don't think I will be posting daily videos for the next couple weeks. I know I'm supposed to do that for the algorithm, which, by the way, if you could like this video, it would be very helpful. But really, I don't have a whole lot to speak to. That's kind of all I'm doing. I'm kind of just sitting on my hands and slowly buying into the big dips that we are going to inevitably have. Today, for instance, Eli Lilly got hit pretty hard, down 3.6%. It was up to 960. Now it's down at 911. 900 is a very strong support zone. It's got the 200-day moving average, and it's, you know, a $900 psychological support. So this is really not a terrible place to pick up a share of Eli Lilly if you're trying to. But, you know, I would maybe, you know, give a wait and see approach. Healthcare got hit really hard today. I think it kind of broke some of the, you know, some of the charts here. This looks like a top of a chart to me. You know what I mean? But it is sitting right at support. So you could potentially pick up shares, put a really tight stop loss, and maybe it turns around and goes, you know, keeps on trucking as people offload risk. But I don't even think healthcare is going to keep you safe in this market, because it just looks very risk off. TLT looks pretty good though, the treasuries, because we know we're getting that rate cut. You know, we know we're getting rate cuts. And you can see here, you know, rates increased. This thing dropped like a rock. There was speculation, oh, they're going to give us a rate cut. Nope, they're not. Maybe they are. Nope, still waiting. And now we know, okay, yeah, we're going to get it. So I suspect that this thing will run to like 110 once we get start the rate cuts, once they become real and they actually happen. I think that this thing, you know, it definitely bottomed over here, and I just don't see it going down in any significant way if we get our rate cuts, and especially if the data is bad and it looks like maybe we are going to recession. If you hear those talks increase, 20-year Treasury bond ETF looks pretty appealing to protect your capital and still get some gains. So thank you so much for joining me. If you aren't a subscriber, maybe consider subscribing, and I will catch you in the next video. Risky Brian out.